This is the story of how a specific shift in regulatory reporting requirements forced the world's largest publicly traded uranium producer, Cameco, to fundamentally change its assessment of supply chain security. In early 2024, the landscape of nuclear energy underwent a quiet but profound transformation as the United States enacted the Prohibiting Russian Uranium Imports Act. This legislative shift, which officially entered into force in August 2024, did more than just ban material. It forced a total recalculation of how risk is measured in the nuclear fuel cycle. For Cameco, the leading Western supplier, this regulatory change was the catalyst for a massive internal audit of their global supply strategy. The company had to acknowledge that the era of fluid, globalized nuclear fuel was over, replaced by a system where the legal origin of a molecule is as important as its physical availability. This was not a theoretical adjustment, but a multi-billion-dollar strategic pivot. By the time Cameco released its 2024 annual reports, the company had shifted its focus from simple production volume to what they term contract security and jurisdictional certainty. The mechanics of this shift are found in the intersection of national security policy and the complex environmental mandates of the Canadian Nuclear Safety Commission. While the ban on Russian low-enriched uranium grabbed the headlines, the real pressure for Cameco came from the new administrative burdens required to prove non-Russian lineage for every pound of triuranium octoxide. These regulations require producers to implement granular tracking systems that govern the path of ore from the Athabasca Basin through various international conversion and enrichment facilities. Cameco reported that these heightened transparency requirements, combined with the need to diversify away from Russian-controlled processing, have introduced permanent friction into their operations. In 2024, the company recorded a record annual production of 20.3 million pounds from its Key Lake mill. Yet this achievement was tempered by the realization that the logistical, just-in-time models of the past 2 decades were no longer viable. The cost of compliance and the risk of regulatory delays at facilities like Port Hope and McArthur River have become primary variables in their pricing models. Looking deeper into the hidden mechanics of this recalculation, we see a company preparing for a world of bifurcated markets. In their recent disclosures, Cameco leadership highlighted that they are no longer merely competing on the cost of mining. They are competing on the reliability of their legal and political standing. The regulatory hurdles are not just about safety, but about the hardening of economic borders. This was evidenced by the sudden halt of production at the Inkai joint venture in Kazakhstan on January 1, 2025. This stoppage occurred because the controlling partner, Kazatomprom, failed to submit specific regulatory documents to the Kazakh Ministry of Energy on time. While production resumed 3 weeks later, the event served as a stark reminder of why Cameco is recalculating its risk. The company has since reduced its outlook for market purchases and increased its reliance on standby product loans to offset production volatility. They are moving away from the spot market, which they now view as an unreliable indicator of true value, and are instead locking utilities into long-term contracts that include what many analysts call a security premium. The global context of this shift is equally intense. As the United States and its allies attempt to de-risk their energy grids, the burden falls on Western majors like Cameco to bridge the gap. In 2024, utilities placed approximately 119 million pounds of uranium under long-term contracts, a significant volume that still remains below the annual replacement rate of 150 million pounds. This gap represents a growing uncovered requirement that Cameco is uniquely positioned to fill, but only if they can navigate the tightening regulatory net. The company's strategic acquisition of a 49% stake in Westinghouse, alongside Brookfield Renewable Partners, was a direct response to this environment. By controlling both the raw fuel and the reactor technology, Cameco is attempting to create a closed-loop Western supply chain. This vertical integration is a hedge against the very regulatory and geopolitical risks they are now forced to recalculate. They are effectively betting that in a fractured world, customers will pay a significant premium for fuel that comes with a guaranteed Western-regulated pedigree. The real-world impact of this shift is already being felt across the commodities market. In late 2024 and early 2025, the spot price of uranium experienced significant volatility as participants tried to price in the new normal of restricted supply. Cameco's announcement that it would produce 18 million pounds at both MacArthur River and Cigar Lake in 2025 was initially seen as a stabilizing signal, but the underlying message was one of extreme caution. Every pound of uranium that Cameco produces now carries the weight of increased carbon compliance costs and Scope 3 emission reporting requirements, which the company externally verified for the first time in 2024. These ESG-driven mandates are not just side notes. They are integral to the new regulatory framework that determines which producers can access Western capital. For the average person, this means the cost of carbon-free baseload power is being repriced in real time. The transition from a globalized, efficient market to a regionalized, secure one is expensive, and Cameco is the first to put a clear price tag on that security. As we look toward the future, the implications of Cameco's recalculation suggest a permanent change in the power dynamics of energy. The company's focus on long-term contract protection over aggressive expansion indicates that they believe supply risk will continue to outweigh demand risk for the foreseeable future. This is a disciplined retreat from the produce at all costs mentality of previous cycles. By acknowledging that regulatory friction is a permanent feature of the modern energy landscape, Cameco has signaled to the world that the era of cheap, easily accessible uranium is over. This is not just an update for shareholders. It is a diagnostic of the new geopolitical reality. The rules that once facilitated trade are now being used to define the boundaries of national security. As other industries, from semiconductors to rare earth minerals, watch this play out in the nuclear sector, they may find that the Cameco recalculation is the first of many such shifts. The story of uranium in 2025 is a story of how transparency and policy became more valuable than the resource itself. Ultimately, this shift represents the end of the peace dividend in the energy sector. For 30 years, the world benefited from the conversion of Russian nuclear warheads into civilian fuel under programs like megatons to megawatts. That surplus is gone, and the regulatory walls are rising in its place. Cameco's strategic pivot is a response to a world where clean air and energy security are no longer separate goals, but are tied together by a complex web of legislation. The company's decision to prioritize contract discipline over spot market volume is a clear indication that they expect the supply deficit to persist well into the 2030s. As they navigate the requirements of the Atomic Energy Act and the evolving standards of the Canadian Nuclear Safety Commission, they are writing the playbook for the next era of industrial competition. The quiet recalculation in Saskatoon has become a loud signal to the global markets. In the new energy economy, the most important asset isn't just what you have in the ground, but the regulatory certainty required to get it to the grid.